Good evening, everyone, all traders, investors, students of the market, subscribers, and welcome to the Nightly Market Intelligence Report. This is Jeff Killian, Chief Market Strategist for the Inside Technician. Let's get right to work tonight and talk about the current state of the U.S. markets and some of the real probabilities for future directional price movement and a lot of opportunities that we have already taken advantage of and will continue to do so in 2013. The time is 7:08 p.m. The date is January 6, 2013. And as we look at the current chart of the Dow Jones Industrial Average and zoom in here, I want to focus in on the last two sessions prices here on the 3rd, and again on the last session on the 4th. Now what we do have is a crossing of a significant resistance level that was laid out at 13,350 by these two prices right here, as they had previously been broadcasted out from these two data points here and again here on 10/23. So where that leaves us at the moment in time is a trading range that has been established between 13,350 by 3 up closes above this level, again, as compared to the previous resistance level right here as laid out by these prices broadcasted out into the future, leaving the top end of the trading channel newly established of 13,355, again, 13,355 to the upside, and the downside is 13,350. Superior resistance lies here, and then again, obviously, at the next level to the upside. If we take a look at what we really want to know is this level here at 13,615. If we back the charts back up here at 13,623, this was laid out from all the way back in 2007. So if the market continues to trade up and up and up, based on the news-driven event, the fiscal cliff being temporarily viewed as positive, we will get through this level and again through the next level to the upside, 13,623, broadcasted out from 2007. Now, will prices hit here and a possibility of sideways movement? Absolutely. Could prices hit here at 13,623 and move sideways? Absolutely. What we would prefer to see is prices not continuing to trade up on news-driven event prices. Although prices are the leading indicator, we prefer to see some volume come in here to act as the reason to trade through these prices into a new territory within the Dow that has not been seen in a long, long time to take larger positions. Let's take a look at the indicators. These are the levels that we need to focus on as the indicators continue to rise up. Now, the MACD cross to the upside after the market sell-off we called here took place is left us with levels that have been broadcast out from the past, as in here and again right here. We're almost there right now. As these indicator levels get hit, and again here, it's clear to see that these levels, as they were broadcasted out into the future from the past, can coincide with the price levels that we just laid out and we looked at. So this is the real relative comparison of any indicator that has been back tested out, that has been proven out to be a smart money trading indicator that we're going to use every day. We need to look at the relative comparison of where these indicator levels are when the same price levels are hit. Let's take a look at the Chaikin Money Flow 21 period. Moving up again, its internal level is right here. The next level is laid out here and here. So here we are again in a situation where we have prices trading up on artificial highs without the smart money volume behind it as clear accumulation, getting back to levels on prices, getting back to levels on indicators. This is what a professional trader will look at and see how the prices react at those levels. Now, we talked about this before. The money flow index here, 14 period, has completely sold off here. Its momentum has been fully weighted to the downside, a little up movement here. And this really confirms the total lack of real smart money volume that has come in to drive these prices up in a genuine way. So that in isolation, as compared to the prices, this actual proof, the objective analysis, leaves the move suspect. Where prices are the leading indicator, we have no choice but to be level 6 long. But this means with caution. And as you see these resistance levels on the way up, this is where we're going to, again, look at how prices will react. EMA is crossed here on the big day up. Again, stochastics crossed from below to above and upward momentum. Here's an internal level. Here's another one here, getting real close to overbought territory. So again, the overall state of the U.S. markets as called by us is now officially level 6, smart money, trading methodology, long. Why? Because prices are the leading indicator in any trade. Okay, let's get out of this and get right into the sectors and the ETFs that are traded against them. A lot of very highly profitable moves called by the smart money trading methodology. Here we are. Now, what we did in most cases is we covered the short and went long as soon as the market had turned around, which was the correct thing to do. Because in this case, we really didn't have anything to lose and a lot to gain. With short stop setup, if things went against us, we would have gone out with very small losing trades or break-even trades. But in this case, it worked out because the market has sustained the move by the last, again, what we talked about on a Dow, the last 2 trading sessions. Now, in this particular sector, the 30 consumer staples, what we do have is superior resistance that's laid out from here. Now, we need to get through this. Prices are leveled off right here. We don't have any real smart money in here. So again, trading up on inflated highs, nothing to lose, getting right in here, being long, in the money again, and will remain long. It is impossible to tell whether tomorrow's volume across the U.S. equities will come in to push prices to a much higher level until it actually happens. We're prepared for that. We are ready to capitalize on that, and again, leaning to a stronger bias level, which will then change from a level 6 to 7. So as it stands tonight on 1/6/2013, the smart money bias call remains long. On the ETF symbol traded against what you're viewing, the 30 consumer staples sector, XLP, the ETF, we are still long. Let's take a look at the next chart pattern. Is considerably different. We've already crossed from below to above substantial resistance as laid out by the latest level right here to the back side and then to the front side right here. 3 closes above. Excellent long. We covered the short, went long again here at 357. We are in the money. We remain long again tonight on the ETF symbol XLY traded against the sector reviewing 25 consumer discretionary. Here, what an incredible move that was called way back here. For those of you who have been tracking this every night, you know very well that on the night of 12/10/12/11/2012, we had called this. Here it is, 210. We left it in there for you. We're up 19.25 right now on this trade. We never got out of it when the market corrected because the relative strength was so positive as compared to the market. So again, the 15 materials sector has shown us clearly what can be had when you're selecting the right ETF symbols to trade against them, in this case XLB. So one more excellent winning trade in progress. Again, we remain long tonight, the ETF symbol XLB traded against 15 materials. Here, no call on the XLE again, the dog of dogs, even though smart money came in here a little bit here, the chart pattern set up, and the reaction to the most recent market conditions does not warrant any call on XLE. Let's take a look at 55 utilities. The ETF symbol traded against it is XLU. We have a possible entry on the AM session tomorrow. And why? Because of a gap away here. And now, where we had to get out, where we were short and had a very small point losing trade, let's take a look at what has happened. One close above this level right here as laid out by these prices, eliminating the blow off here. 1, 2, and 3 with almost no resistance back to a minimum of this level, broadcast it out into the future. And then all the way back up to here. This is why. The stair step down provides clear-cut price profit targets to the upside here and here for an excellent setup based on the additional volume that came in here and the gap away, indicating a lot of strength as compared to the other sectors. So when we trade, we have to understand that at any moment in time, we have to be able to change our position. And this we do by reacting in a timely manner, all based on objective analysis and not the news. Okay, so again, 1/6/2013, we have a possible entry on the AM session. I'm just looking to see how the equities are going to open. The futures will determine what's going to happen on the equity side for the open session. We're going to get into that shortly. Here, we remain long on XLI, the ETF symbol traded against 20 industrials. In here, we crossed from below to above superior resistance on the blow-off area here before the correction and full upward momentum. Again, additional volume in here. It's going to turn out to be an excellent trade. Let's take a look at something a little different here. We are long, and what we're looking for in this case is the higher probabilities of prices leveling off on a short-term correction on the big bar up, possibly even down to this level right here before beginning to trade to the upside again. If prices hit this level and start to trade through it, we'll be out of this immediately because we're not giving any money back after the end. That will be that. Here on the 40 financials, way back at this point right here, where the additional volume had come in after the uptrend had been established. We were in on a smart money bias call on 12/6/2012, and we have never, ever looked back. 18 points and counting on the last close in the money to the upside. We remain long on the ETF symbol XLF traded against the 40 financials. Excellent trade. Here, the smart money is long again tonight. The smart money bias call is long on the ETF symbol XLV traded against the 35 healthcare sector that we are analyzing tonight. Let's take a look at something else here. You know, when we look at futures, and we'll get out of these completely here on the sectors, so we can get right into the futures. When we look at the futures, we look to the futures because the futures will lead the equities prices most of the time for the AM session. Now, what we do have at the moment is more bias to the downside on an intraday basis for tomorrow's opening than we do have positive. Now, this is of right now, 7:21 Eastern Standard Time. We have the entire overnight session to go that will lead us to the conclusion as to exactly what should happen for tomorrow's opening on the equities. But let's take a close look at what we have here. And what we do have is something similar but not the same on the actual levels. We have a lack of volume here at the time, which confirms the same as the Dow. Price is trading up artificially based on the event-driven news. The futures have never closed the gap between 1231 and 102. 2013. Now, this gap may never be closed, and it won't be anything that is new to us, but it's new to us at this moment in time. Now, we do have a trading channel that has been established because of the higher close on the most recent session at this time, and that level has been established by these two prices right here, and that level right here at this moment is 1457.25 right here. The level to the upside is 1465.75 as outlined by these two prices right here. So this could be a level that is contained for some time. If prices trade back to the downside, the level to the downside right now, the most prominent level is right here as established by the close of 12/18 at 1444.75 to find support. So those are the current levels. Anything beyond this right here traded to the upside, again, would be considered to be a brand new territory for the most intermediate term price movement, and we would change our smart money bias call long to a level 7 or possibly even an 8. Prices trade through here with a lot of volume to the downside, pushing them through with a lot of momentum. We need volume to take larger lots. We need a lot of volume when we get through these levels to give us the confidence to trade a larger amount of contracts. Now, what we do have is the Chaikin advanced decline oscillator on the continuous contracts is still giving us a negative divergence as compared to the inflated highs because of the event-driven price move. Here, again, as we talked about on a Dow, a level. Stochastics is clearly reaching right here near the overbought zone, another level here, okay, as prices trade up and the indicator moves up in tandem with the prices. We have resistance levels laid out by prices and internally by indicators, previous levels that have again been broadcasted out into the future. The reason why I'm going all through this tonight is because I want everyone to understand that as we become beta traders or investors, there is a process that we must go through every single night in order to be able to find, track, and trade the smart money. In order to do that, we need clear levels that are laid out, broadcasted out from the past into the future to be able to determine when we need to be looking to be out and when we really need to be looking to be back in, like here, like here, like out here, like stronger bias to the downside, turning to a level 8 or 9 for the big sell-off, like changing the bias after we've crossed and moving strongly to the upside, crossing trend lines to trade more contracts on an intraday basis, but first analyzing the Dow and the E-mini futures continuous contracts on a daily basis to know where you stand on your trading levels and where you want to load up to make the lion's share of money in a short period of time. What we do have here in this case is a secondary Chaikin money flow negative divergence right here as compared to the Dow after the trend line break. So we are long. Based on everything we're looking at, we are correct. Short-term money flows up. We're right to be long, but with caution. We are only at a level 6 right now. So what does this mean when we talk about the intraday trading? What it means is that we're going to trade less contracts. So let's take a look at that right now and see exactly where we stand and what the real possibilities are for the overnight session and how we can make money trading it. That is what we need to know. Here we are. The current bias is to the downside, but before we get into some of the indicators on the 15-minute charts which dominate the intraday price moves, on the 1-minute chart, we get the precision entry and exit. Right now, we have a level that's laid out at 1457.75 right here by these prices. Broadcast it out into the future, and here's where we are. Now, why? These prices here, this low, these lows, right here. Again, the most recent low right here. Okay, we're talking about the 7:24 p.m. Eastern Standard Time bar. Probing. The next level to the downside, if prices trade down, is 1456.50 right here. The next level to the downside, price profit target 2 is 1455.75. The next level, the fourth level to the downside, the third price profit target becomes 1454.75. Now this is something that we would trade, and we will trade tonight because we're up and ready to go. If these prices, as the indicators come to fruition on a real high probability trade, get through this level right here at 1457.75 that's been established right now with some serious volume behind it as it gets through this. For those of you who have been watching YouTube, I have been starting to upload quite a few recently real-time trades that are recorded. And we'll continue to do this as we get closer to the end of February when the real-time trading lab will be open. So these are the levels to the downside clearly laid out. Let's take a look at the 15-minute indicators. Since we've started the tonight's broadcast, we have more downward momentum right here from the money flow shorter term after a substantial negative divergence as compared to the run-up of the prices. Here's your blow-off classic case right here. Prices move down. Here's your tail down. We saw in the 1-minute charts. And here we are down, and it appears that prices can, again, trade to the downside and hit these 1-minute targets. Let's take a look at the EMAs crossed right here at this level at about 1460.25. Now, since that's happened, they have never looked back, and they are still showing us clearly, confirming the short bias. Let's take a look at the MACD indicator crossed right here. When? On 1-4 at the 4:15 p.m. bar at the end of the E-mini futures session. Never look back. The disparity is wide, full downward momentum, a lot of levels for itself to get to on the way down. A lot of room to go yet on this indicator. Stochastics crossed way back here, way down. What I want everyone to see is the relative comparison between this chart pattern on the way up for the short move and this one. This is exactly why this move to the downside here was taken by us and this one was not, because of the higher volatility within this chart pattern, clearly stating a much higher degree of difficulty to trade it. This is the preferred chart pattern setup. This is not because of the increased volatility. When you're looking at this, whether short or long, if you could take this and flip it upside down, that would be more the type of chart pattern that we really need in order to hit these trades running. Let's take a look at something different here, a complete dump from the Chaikin money flow. This level here as compared to this, if we measure from here to here and look at the up move, we cannot get back to this level. We cannot get back to this level. Cannot get back to this level. So we have increasingly decreasing levels of the Chaikin money flow as compared to the up move, leading us to the short bias on the downside, looking for the termination of a high probability setup to turn into a trade that we will take and will report on tomorrow night's broadcast if it's taken. Okay, back to the 1-minute chart. Again, these are your levels, traders. Right now, the level to get through to trade to the downside is 1457.75. The price profit target 1 is 1456.50. 1455.75 on PPT2 and PPT3 is 1454.75. The suggested stop in crossing through this level to the downside would be a point no greater than 1.25 points, to the upside. Okay, and so that level would be approximately 1457.75 plus 1.25 at a max is 1459. So let's go ahead and get in here right now and let's lay it out for you. At 1459. And there it is. That would be the approximate area to place a stop, because the distance between the N and here is 1.25 points, and the ultimate price profit target is all the way down to here at 1454.75, leading our way to clear a greater than 3-to-1 risk to reward ratio. Good trading education tonight. My pleasure to present to all of you. We'll see you tomorrow on the next Nightly Market Intelligence Report. Good night.